So let's start off with the fundamentals. So from a fundamental perspective, we have news from JPY, we have news from central banks, US, and then also China and Russia. So to start off, let's talk about Japan first. As we know, Japan in the beginning of the pandemic, they're pretty much the Japanese economy was pretty strong for staying open, while a lot of the other economic or developed economies were locked down. So now we saw over the past year or so, we saw how Japan kept going back into a state of emergencies. So it went back into a state of emergency the first time, and then after that, they started to ease up the restrictions a little bit. But when they saw that the cases were still rising, they went back into a complete state of emergency, and that happened a couple of times, about 3, 4 times. And now they have finally opened up their economy again, slowly coming out of that state of emergency. But now we're starting to see this, while a lot of other developed economies, they're starting to have a lot of vaccine optimism. In that same space, we're seeing that Japan is still behind. So we saw that UK and US, for example, they're doing pretty well with vaccines and mass vaccinations. But we're seeing that EU is a little behind, but now is starting to pick up space again, or pace again. And then also with Japan, it's the same exact thing. So they opened up their economy, um, came out of state of emergency, but a lot of their citizens had this uh, fear of taking the vaccines because of the blood clots that were associated with Johnson and Johnson and AstraZeneca. But now we're starting to see that those citizens would much rather get a vaccine and have some sort of partial immunity. So now we're starting to see a little bit of strength, and also we got further strength when there are talks about a new supply of vaccines between the Prime Minister of Japan and Pfizer. So he hopes to secure some supplies for the entire country by the end of September. And he did tell the reporters today that Pfizer and the Japanese government will be holding talks. So that's bringing in some optimism that now he's able to secure some more supplies for his country and some more vaccines for his people. So that's bringing in a little bit of more optimism. And as we know, right now, a lot of the focus is on countries that are able to take a control on their vaccinations, take a control on the virus cases as they're increasing. So they want to see, as the economies are opening up, how are these countries going to pretty much still maintain a pretty healthy healthcare system. So they're trying to see, a lot of the investors are trying to see that if the economy completely opens up, and obviously there are going to be increased cases as you open up the economy, how will the government make sure that the healthcare system is again not overheated like it was last time? And then ultimately making sure that they're not going back into lockdowns, right? So just because cases are increasing, how do you ensure that you're not going to go back into a lockdown? And how are you going to take other measures to address this problem instead? Any questions so far? All right. So where we're seeing that a lot of the countries, they're starting to vaccinate another larger group now. We're seeing that Japan is still kind of behind in that, in the sense that they're now starting to vaccinate their elderly, their healthcare officials, their frontline workers, and then slowly they're going to start moving into uh, other categories. So right now we're seeing that while the United States and the UK, they're starting to open up vaccinations to a younger age group, we're seeing that Japan is still a little bit behind. So it's still weak for the most part, but we're seeing that there's bursts of optimism here and there. And ultimately, Japan is going to start picking up its pace. So by September, they're going to start having more supplies. So that means that you're going to see a lot of market sentiment playing a big role when it comes to the Japanese yen. Any questions on this article? No? All right, going into central banks. So a lot of the central banks, let's go ahead and move down. So a lot of the central banks, they're saying that they're going to hold their interest rates this year. They're going to maintain them. So let's go further down and see what pretty much each central bank, so the Federal Reserve, European Central Bank, Bank of Japan, and Bank of England are saying. So with the Federal Reserve, they're going to continue buying $120 billion worth of treasuries and mortgage-backed bonds every month until they see substantial further progress on inflation and employment. So what that essentially means that they're going to continue buying back these bonds. They're still going to continue putting money into the economy, and they're going to maintain that for pretty much for the next coming months or so. And for the rest of the year, and we've already seen Powell saying that he's gonna, until 2023 and 2024, they're gonna maintain their interest rate. So a lot of the data points that we're gonna start seeing coming out with PMI, retail sales, CPI, any of that, those will be the key data points that the central banks will be looking at. And as those numbers start to increase, as we know already, there's already concerns about inflation, but also the central bank saying that if inflation gets out of hand, then they know they have the tools to take control and pretty much maintain the interest rates to an or the inflation rates to an optimal level. So we're seeing that right now from the Central Bank of America, which is the Federal Reserve, and this is the same sentiment that we're seeing across the board with a little bit of variation. So at the moment, ECB as well pledging to keep financing conditions for governments, companies, and households favorable until the coronavirus crisis phase is over. So right now they're purchasing about, or they're using about $1.85 trillion euro pandemic emergency purchase program to keep the bond yields low, and they're still putting money into the economy through these bond purchases and these programs, these economic programs that we're seeing across the board. So essentially, in every country, you're going to see it being called something different. But what they're doing for the most part through these policies and through these programs is they're injecting money into the economy. So either they're giving stimulus checks directly to the consumers. That's one way to inject money into the economy, because you give money to the consumers, they're going to go out and spend money at retail stores. Another way is, for example, you're going to see some variation of tax payments or social security contribution deferrals, something like that. Also, just so people who do have jobs right now, they're going to have to pay less taxes or contribute to less to their social security. So that means they get to have a little bit of a bigger check than they would usually go home with. So you're going to see some variations of that. You're going to see some subsidies coming in as well. For the most part, that's what a lot of these central banks are doing. Same thing with Bank of Japan at the moment. They're going to maintain their policies, their main policy settings on cruise control, and they just had their biggest policy review in March. Let's continue down a little bit more. So you're seeing a lot of fear of inflation, not just in the United States, but also in Japan. We're going to see the same exact thing in the UK and in Europe as well. So as you keep injecting more money into the economy, eventually it's obviously going to have effects on inflation. But how do you make sure as a central bank and as a government that you don't end up having hyperinflation to the point that you're not even able to control the inflation in your own economy? That is a major problem, and there have been several examples of this. So, for example, Venezuela is one of the countries that has hyperinflation, and because of that, it's also going to affect your fiscal policies. It's also going to affect any foreign investments. It's also going to affect your currency as well. So, hyperinflation tends to make currencies super weak and unattractive to international investors. So as you can see here, pretty much the same thing that we've seen with the European Central Bank and also the Federal Reserve. They're looking to extend their special pandemic funding measures from the current September expiry date. Bankruptcies falling, bank lending growing. There appears a little reason to add measures supporting businesses. So what they're doing is they're maintaining it. They're not increasing it. They're not really decreasing much. They're just going to maintain it at the same pace until they see some progress being made. And when they say progress being made, it essentially means employment levels picking up again, unemployment dropping, inflation being at a favorable level, so it's not too high, but also it's not too low. So things like that. And then finally, we're just going to take a look at Bank of England, and there's a couple of more if you're interested in this article. Bank of England, same exact thing, is firmly on the fence about whether his next move is to administer another dose of stimulus or monetary tightening of the UK economy. So with Bank of England, uh, it's for the most part it's the same thing. The only difference is that now they're starting to see economy opening up. They're starting to see that obviously employment numbers are being affected as well. So now as the economy opens up, what they need to essentially see is employment levels picking up. So we know that in the past couple of weeks, we've had articles and news about businesses burning out their cash. Also, a lot of jobs are moving from the UK into the EU. So, how do you make sure that you're maintaining a healthy number of employment in your own country? So, this is another battle that the UK has to face at the moment, and these are post Brexit consequences as well. So, what I mean by that is in a lot of the sectors of the UK, they have been affected heavily by Brexit. And one of them is the financial services. So as we know, a lot of the businesses in the UK, if you have clients in the EU, you can't directly approach them. You need to have an EU middleman, and having an EU middleman is obviously additional cost to those businesses that are already being affected because of the virus, right? So that's additional cost to them. That's also what you're seeing firms doing is instead of hiring a EU middleman, why not just move there and then reduce those costs, right? So a lot of the jobs are moving from the UK into the EU. So that's just one aspect of it, but there's a lot of different examples of the same exact thing. Another post Brexit consequence is um, on the borders when there's a lot of export and imports going on, in order to move those goods from the UK into the EU and vice versa, now you need to have special certifications or a license, right? And that is also an additional cost, and that's also causing a lot of backups on borders of the UK, Northern Ireland, and also the EU. Any questions at all about this article? And their next decision is going to be on May 6th here. Pretty straightforward for everyone. So going to Russia and US, as we know, US is placing sanctions now, and we talked about this in our previous outlook and our breakdown. So now, in response to those sanctions, now you're seeing Russia, who's working a little bit more towards becoming self-sufficient. And there's a couple of specifically I chose this article because there's a couple of charts that actually show how Russia is starting to become a little bit of more self-sufficient than the US dollar, and they're trying to move away from the dollar itself. So as you can see now, Russia is holding more gold than the dollar, and over the years you see like how they pretty much dropped down their dollars in 2018, and from there they start to increase a little bit, but now since 2020, that's when you see the bigger transition of Russia holding more gold than the dollar. So they're trying to move away from this world reserve currency, and they're trying. This is pretty much their way of responding back to these sanctions that the U.S. has applied onto the U.K. And they have also shifted most of their assets out of the U.S. And so, as you can see, these numbers are pretty much decreasing. So this is the share of international reserves held in the U.S. So the share of Russia's reserves held in the U.S. And as you can see, it picked back up again in about 2020. It picked up a little bit, and then it's coming right back down slowly. And same exact thing here. So Russia has reduced their dollar share in its exports since the sanctions have hit. So for the most part, as you can see, the big shift comes again in 2020 when they start holding more of euro and their own currency versus the dollar. And then you see quarter three of 2020, same exact thing. You're maintaining the change that they had in 2020 here, quarter one of 2020 and quarter two of 2020. Any questions on this? This is pretty much their response. And you're going to see a lot more of this happening. And all this really comes down to what I want you guys to get out of this is that now there are tensions obviously increasing between the US and a lot of other countries, and global tensions increasing in general. And also with China. So we know that with the previous administration, there was this concept and discussion about China being one of those bossing countries around, and that's what the previous administration was trying to move away from. And now we see the same exact thing coming from China about the U.S. So telling U.S. and its allies to avoid bossing others around, and this is just another confirmation that now you have global tensions increasing. And we have seen this on the charts. We have seen that once there's optimism coming from a technical perspective, you see price hitting key levels on monthly, weekly timeframes, and then you have fundamentals coming out. We're going to see a ton of more of global conflicts. And that brings us, these two articles specifically, that bring us to the gold analysis that we're going to do. So that's why I specifically want to talk about these, because as global tensions increase, you're going to see gold increasing as well. So a lot of people, they're going to be, a lot of the institutional investors and foreign investors, they're going to be moving their money from risk currencies back into safe haven currencies and commodities. Any questions on any of the Bloomberg articles here? All right, so this week, let's just take a quick look at what can we expect, what kind of news is coming out, and what sessions to watch out for. So today, pre-Asian session or pre-London session, you have a ton of GBP news coming out, mostly important news, which is the claimant count, which is unemployment. So you have unemployment rate, and then you also have people who are applying for unemployment benefits in the previous month. So today's pre-London session is going to be important. So definitely wait. We're gonna wait for confirmations before we take our trades today, and make sure that we try to wait until the market prices this in at market open. Then going into tomorrow, same exact thing. You have a ton of GBP news coming out in pre-London session. So wait until London session opens up, and maybe you might even catch a trade pre-London session as we get closer to London session, maybe like 30 minutes before, 15 minutes before the session opens up. So today we have unemployment. Tomorrow you have CPI, PPI, and the RPI, which is the retail side. So this is the stuff that, well, you can essentially apply the knowledge that we got from this webinar on Saturday. So this is where you can apply it, and you can see exactly how does it affect the currency, and try to understand what does this mean if CPI comes out at a certain percentage compared to the previous and the forecast. What does that essentially mean about the UK economy, and what is it forecasting for the future, while you in accumulation or in coordination with everything else here. So that's pre-London, and then going into London session. In the middle of the session, you have Governor Bailey speaking. So 30 minutes before his speech, there's definitely going to be some volatility. You might see a little bit of consolidation. You might see volume dying down a little bit, and that's just the market trying to price in or get ready for Governor Bailey's speech. And then from there, we're going to see better movements going into New York session, where mostly it seems like the Canadian dollar fundamentals are going to be dominating that session more than anything. And then you have crude oil inventories coming out. That's if you're trading oil or USD CAD in New York session. And then we have a pretty calmed down pre-London session tomorrow, and then going into London set or on Wednesday, sorry. And then in London session on Thursday, you have industrial order expectations. So make sure you're paying attention to all this data here, and that is going to help you forecast the industrial order expectations. And what I mean by that is, if on the retail side numbers are starting to pick up again, and CPI numbers are starting to pick up again, and PPI numbers are starting to pick up again, then you may see some nice boost in the industrial order expectations. So this comes down to some of that example of what we talked about, Walmart and T-shirts, and if, for example, Walmart is able to sell enough T-shirts to their consumers, and obviously to restock their inventory, they're going to be putting out more orders. So this tells you a forecast of how the economy's health is doing from a manufacturing perspective and from a services perspective. And then definitely expect the market to slow down and consolidate a little bit on lower time frames as we head into pre New York session, where you have the interest rates coming out of the euro, and definitely pay attention to what they're saying in their monetary policy statements. So as we saw in central bank's article, for the most part, they're going to maintain they're going to maintain their financing conditions for their governments, companies, and households for favorable until this crisis has passed. So they're just going to maintain the interest rates. We already know that. They've already said it. And they're also going to talk a little bit more about the economic outlook that they have. For the, I'm pretty certain that they're going to mention the outlook depends on the course of the virus, but we want to pay a little bit more attention to what are the factors that they're looking for in order for them to increase their interest rates in a couple of years or so. Any questions? No? And then
Yeah,
you have unemployment claims coming out in New York, and then you have some scattered USD news coming out in New York session.
Vijay, today unemployment rates will be coming from GBP, right?
Yes.
So they are expecting no change from the previous one, like it will be 5. Uh,
The
so
unemployment rate, yeah, it's going to maintain, but they're expecting a decrease in the claimant count change. So this is the data that's going to be priced in maybe in the next unemployment rate that we're going to see from the UK.
okay, so this is gonna drive GBP up.
Well, we'll see how it comes out, right? Like I can't tell you right now it's going to go up or down. So we'll see how it comes out. Sometimes what the market does is if it's fairly close to 24.5k, for example, obviously they're expecting less, which is good. Sometimes if it's closer to it or a little bit above it in the first 15 to 30 minutes, the market might react to it in a negative manner. And just the fact that it's a little bit higher than they expected, right? But if you look at it from actual versus previous, then obviously it's lower than that, which is going to cause some positive effects on higher time frames. So we're going to have to wait until it comes out, and then we'll see exactly how the market's going to react.
I mean, theoretically, it should move up, right?
Again, we'll see. I can't give you an answer, but like I said, if it's closer, but if you're looking for scalps, you want this number, which actual, to be much closer to the forecast
Mhm.
and maybe even lower. But if you're looking to turn that scalp into a swing trade or into a day trade, then you just want to make sure that the actual is less than previous. So there's two different factors depending on what kind of trade do you want to take.
Mhm.
But yeah, continuing on, you have a ton of news on Friday. So definitely going into Thursday and Friday, you definitely want to be a little bit more careful with your trades, given that on Thursday you have interest rates coming out of Euro and then unemployment claims right into New York session. And then you have a ton of PMI news coming out of the Euro, GBP, and the US dollar. Everyone good to move on to the technical side?
Yes.
All right. So with GBPJPY, let's start off with the yearly time frame. Clearly, price came up and rejected. I think the previous numbers that we had was 152,300, so we'll maintain that just for consistency purposes. But price came up and rejected right into this area. At the moment, we're still sitting in this zone right about here. So we're still sitting right into the zone. We want to see how is price going to react here. So these are key areas here from the yearly time frame. So obviously, whenever price is in these zones, you definitely want to be careful with your trades. There's going to be a ton of consolidation. You're going to see some uncertainty because again, to break past these key levels from the yearly, quarterly, monthly, weekly time frames, you need to see fundamentals to support these moves to the bullish side, or even if it pulls back, then either JPY strengthening or GBP weakening for whatever reason. From the quarterly side, at the moment, we're pretty bearish. We made one little small top wick rejection, but for the most part, we've been quite bearish to the downside, tapping into previous resistance levels, 148,300, where we have price rejecting this level over and over again. So we have the first rejection right here, and then as we move further to the left, you have resistance being made. You also have a support right into this level, and then with this candle here, you have this little break and retest to the downside, and then wick rejections for the most part. So you have several of them, and then this consolidation right onto this level. So personally, for me to look for any position buy opportunities, I would wait until this 152,300 area is broken, continues to the upside. It'll start off with a swing trade, of course, tapping into 156,700, fill that wick, continuation up, and you have this entire zone sitting right above this level. Continue it up top here, and then again at this point, you're going to need fundamentals to continue pushing, and then come back and tap into this key level here. So this is where we want to watch out and make sure and pay a little bit more attention to the macroeconomics of the UK and JPY, because as you can see, for the most part, we've been quite bearish here, even on the quarterly time frame. These are different areas where we've seen some macro news affecting it. For example, the first one being the financial crisis. After that, Brexit being introduced and the votes started around that time. So now when price comes back up to 150, 171, 500, we want to see if price is going to come break this, and then we're going to have some more positive news, positive fundamentals coming out of the UK, eventually tapping into the previous highs, or once we tap into 171 500, are we going to get some more macro fundamentals, bearish macro fundamentals, maybe another uh, something sort of another financial crisis or something like that, that's going to help with this movement down. So maybe this is the key level that you're watching out for if you're going to look for any position trades on GBPJPY. Any questions?
No.
All right. And then as we drop down to the monthly time frame, we're sitting right into this range of liquidity. And how do you know what is this range of liquidity? Because price has been tapping into this level. First of all, you have that consolidation. Same thing here. Once it taps into this pair pretty much flies at that point and then comes back to that 171 500 mark that we marked off initially. And then same exact thing, as price comes back down, it slowly makes our way back up and then taps right into this area, and we consolidate right into this area for several months, right? So for the most part, price does break above, comes back and taps into 156 700, but right after that we come right back into this range, and then you have price consolidating around these areas. So that makes it a liquidity range that we're tapped into right now. We need to clearly break below 148,300 for any position sell opportunities coming back and tapping into 140 level flat, or you need to break completely out of this range here and then continue bullish from 156 700 up to 171 500. You see this a little bit more clearly here on the weekly time frame as well. Same exact thing, where right now all price is doing is consolidating in this zone, right? So we created a weekly support down here last week. It seems like we're continuing bullish, but again, there are no position buy opportunities unless you break out of this range here. We've had the same exact thing happen here where price melted to the downside, tapped into 148,300, gave you a little bit of a fake out, and came right back into the range and failed to break above 152,300. You've had the same exact thing happen right before that, and we're sitting right into that range at the moment as well. Now let's talk about some swing trade opportunities. So clearly price came down here, consolidated all of last week, and once it broke out of this area of 149,800 and this zone right here of 150, 500 mark. So once price broke out of this range, there was a ton of volume to the upside, as you can see. So the previous daily closed very bullish with a bottom wick rejection right into this area. And now we're coming back and tapping right into previous consolidation areas here again. So clearly a lot of volume, but we have seen the same exact setup in our simulation sessions many times, right? Where price continues down and then it'll consolidate, but sometimes you'll see a little bit of a fake out and then price can continue back down to revisit the lows. Or in order for this to run as a bullish swing trades, you need price to give you some sort of a break and retest either on the 4 hour or 2 hour time frame on this daily candle in order for price to continue bullish. So as we drop down to lower time frames, you'll see how there is going to be consolidation. And the reason for that is because now you're tapping into previous key levels to the left. And then also at the moment, price barely made a bottom wick rejection. So clearly, right when the market opened up a few hours ago for this daily candle, there wasn't a ton of volume for price to just continue bullish. If there was a lot of volume that it collected from here, and price had enough momentum to continue bullish, at the moment we would be sitting right into that consolidation area and maybe a little bit higher just on the daily time frame. But clearly we don't have enough volume yet, and it could be because we have GBP news coming out pre-London, so unemployment news, and then further in the week we have ton of GBP news coming out a little bit more. Unemployment, you have let's go back to Forex Factory here. Give me 1 second. So you have unemployment and you have also CPI news, and then on Friday you have PMI news. So we want to be careful around these areas, especially given that you're in that daily consolidation area right there. And let me actually remove this zone. But we know that now we're sitting in yearly time frame zone. So regardless, you want to be careful with your trades here. Does anyone have any questions so far? Or any confusion or anything like that? Going on to the 4 hour, you're seeing a similar um, candle formation here where you have a ton of bullish volume to the upside, makes a small little bottom wick rejection. So we still haven't corrected this huge bullish move up yet, right? So moving to the upside, and you're starting to see volume die down here with a major top wick rejection right into that previous consolidation area to the left. And if you go back onto the daily time frame, that's the same exact area of consolidation that price has rejected. So here, this is another indication to me that we are going to get some pullback very soon. Maybe before even London's opens up, or maybe in London session, we're going to get a pullback and we're going to try to correct some of this move here. So we're going to come back essentially somewhere in this zone, maybe a little bit, just a little bit higher than that. But we're going to come back, try to correct this move before we continue bullish. So it could simply be a bearish candle. So let's say this candle closes like this. So it could simply just be a bearish candle, maybe comes back and taps into these areas. And after that, we see some bullish volume to the upside, or it could be 3 to 4, maybe 5 consecutive bearish candles coming back and tapping into this zone and then continuing back up. The point being is when we're looking for our trades for the rest of the week, we want to make sure that we're taking a look at higher time frames, 4 hour, 2 hour daily time frames, and making sure that you're not getting caught in a massive bullish run up or a massive bearish move down without any confirmations from consolidation or pullbacks or anything like that, without any of those confirmations that this trade is going to run. Otherwise, if you just end up buying at the high or end up buying some bullish run up, you're going to get stuck in pullbacks or consolidation, and that's going to be quite frustrating from a psychological perspective. So from a 2 hour perspective, what we have 2-hour time frame, you have clearly exhaustion right here. Actually, let me zoom out a little bit so you guys can see to the left. But clearly you have exhaustion at this point where you see candles kind of, losing their volume, getting smaller, breaking the low, still trying to continue bullish. And now you have that previous 2-hour rejection up top. Current one is starting bearish. It just started about 45 minutes ago, but it seems like we're going to come back down, either consolidate. That's one way that the market collects orders and then continue pushing bullish, or price is going to come back down and then pretty much give you that retracement that we're looking for in the 4-hour time frame in order for us to continue bullish. So as long as we're above that 150, 600, 150, 500 area, we have buy opportunities. But if we come back into this range here, then we're uncertain at that point because sales are only valid below 149,800 to around 700 area, and the rest of this area here is for buy opportunities. And that's pretty much the lowest we're going to go because the market conditions will change if we drop down to the 30-minute. They're going to change, and so that analysis won't be valid. Anyone have any questions on GBPJPY?
Nope, looks good.
All right. Let's go on to the yearly time frame for gold. So the fundamentals for gold that we discussed today were uh, Russia's response to U.S. sanctions, Russia decreasing their holding, and dollars increasing gold. Their share of international reserves held in U.S. decreasing, and then also China and U.S. Conflicts happening here as well. So we have, from a global perspective, global macroeconomic perspective, we have global conflicts, and that's going to cause foreign investors and international or institutional traders to start investing back into safe haven currencies and commodities. And as we drop down to lower time frames, these are going to be some catalyst for that consolidation that we're going to see, mimicking from the previous uh, consolidation on the monthly time frames. So let's start off with the yearly time frame first, where you have price coming back and rejecting this, let's call it 1680 flat. 1680 flat, price currently rejecting that with the current yearly candle and then pushing back up bullish. We're sitting, it looks like we're trying to pull back to this, we'll do 1800 flat here then. 1798 would have been the roundup, but let's do 1800 flat. We're coming back pretty close to 1800 flat, and then after that, as price continues bullish, we're looking to target some of these highs from the past 1920. So some key levels here are, first of all, rejection of 1680, coming back right into that wick rejection, after which you have this meltdown, which is that 1800, and then you have the previous high, all-time high that was made before 2020 at 1920, and then that's the same exact level that price has rejected before pushing back down to 1680. So the first target for us, 1800 for buys, and then continuation up to 1900 to 1920. But if price fails to break above 1800, then the next target for us would be 1680. As you look on the quarterly time frame, you have the new quarterly candle opening up quite bullish. And again, you're going to get that bullish momentum as these macro and global conflicts start to increase. So that's one factor. Another one is we started getting uncertainty around vaccinations for a lot of the developed countries, where the UK, UK's AstraZeneca vaccine company halted their trials because of blood clots. Johnson and Johnson, same exact thing. Vaccine supply also decreasing in UK, and Japan just coming out of a state of emergency. But again, they've just started their mass vaccination program. EU vaccination has been quite slow, so that's another factor. And then also new COVID variants coming out. So you're seeing a lot of uncertainty and market fear settling in, which is causing institutional traders and investors to invest right back into safe haven currencies and commodities. So what we're going to start seeing here is some variation. Uh, Let me go ahead and just use this. Some variation of this, right? Where price consolidated. So this was your bullish run up as you're starting to see some. This is when the financial crisis happened. But as you were starting to see some economic recovery happening, this is where the most economic recovery was in this consolidation. We started dropping back down after we started getting strong macro fundamentals. So that means the economy is opening up again, not having to put out so much government assistance for their people, businesses doing well, consumer spending picking up again, all of that stuff, right? Bringing in a little bit of more optimism than market fear. We're going to start seeing some variation of that happening right now as well. So we've tapped into previous lows of 1680. We're approaching 1800. We are definitely going to be coming back somewhere into this range here as a whole. And then we're going to be consolidating here until those interest rates start to pick back up again, which is only going to happen if we start to see some positive data from employment uh, for each specific country, especially the developed countries. But for the most part, if you look at it from a global perspective, then employment numbers is doing pretty well. Inflation is being maintained, and conflicts starting to slow down a little bit or decrease, things like that. Bringing in some more investor confidence into risk currencies and assets instead of safe haven currencies and assets. But once again, when you start seeing wars and geopolitical conflicts and tensions happening, that's when gold is going to start increasing again. Let's drop down to the monthly. Same thing on the monthly. What you have is a downtrend, rejection of 1680, coming back and tapping into 1800 area range here. We want to see how price reacts. As we drop down to the lower time frames, obviously, this range is going to be narrowed down a little bit more to be a bit more precise. But I'm using the candles and the little wick projections here at the moment to determine what zone we're in. So once we break above 1800, we need to see some retest and then continuation back up bullish on lower time frames. And that's how we're going to take advantage of that potentially scalp even turned into swing and that swing turned into position trade. It can very well happen and we can come back and tap into that 1900 range itself. So maybe not 1920 specifically, but coming back into that area where we see clearly a lot of wick rejections, price rejecting this area over and over again, even creating that resistance before it drops back down below 1800 flat, creating a support down here, pushing back up. So this is the first key level, and then after that, definitely tapping into 1900 flat. Let's come down to the weekly. Last week we closed very bullish, breaking out of this weekly consolidation. So we broke out of that this week. It seems like we're sitting into another zone, but we're going to look to see if this thing continues bullish. Then we're going to look to see how can we take trades as price is correcting some of this bullish move here. When you drop down to daily 4-hour time frames, you're going to see prices trying to correct this bullish move here. So we're going to see as price makes a support here, how can we carry it up to 1800? But if price comes back into this range, then this is the specific area that we want to watch out for, 1728 flat. The reason being is if you look to the left, that's the same area that price has rejected several times. And we also have consolidated right into that area for about 4 weeks. And then this past week, fifth week, is when price made a bottom wick rejection and shot back up right into that range. So we want to see if price is going to come back down, create some sort of support, and then continue bullish. We're going to take our first trade with our first TP being 1800 from a swing trade and a position trade perspective, and then continuation bullish, and we'll target some more levels as we get closer to them. But this is from a position trade perspective right now as we transition into swing trade. So swing trade, you see that previous daily candle made a top with rejection, closed bearish. This daily candle made a bottom with rejection as well. So I want to see specifically, I want to see price breaking out of this range here. So breaking out of this range here and then continuing bullish, and then we can look for some nice buy opportunities. The reason being is if price can break out of this range, we're making sure that we're not getting caught up in that previous support, which is now the new resistance. So we break out of that, continue bullish, and we can have a pretty nice trade to the upside where your stop loss would be right below the zone, obviously using lower time frames, and then first TP being around 3 to 1, almost 2.75 to 1, and you can also decrease your stop loss along the way. But that would be your first swing trade TP, and then continue it further up. But if you can turn that swing trade into a position trade, you would be looking at almost 30 to 1 risk to reward. So that would be one of the trades that I would personally be looking for as we continue bullish with more confirmation from the market sentiment and fundamental side. But if we come back down into the range, then I would wait until 1728 is broken to carry it down to 1680 or even break back above 1745. But from a fundamental side right now, it seems like we're headed quite bullish and we're going to be following the same exact variation at the moment that we did in the past. On the 4 hour, it seems like we're starting to make some support right into this area, starting to make some support. So let's see if we will break out of this going closer to London session. 2 hour, same exact thing. You have a little bit of consolidation, market collecting orders, respecting previous highs. Let's see if we're going to continue bullish. Any questions about gold, any of the fundamentals that we discussed, or GBPJPY? Pretty straightforward.
Yep.
Yes.
All right,
Straightforward.
awesome. All right, so we're pretty much done here, and then we will start our live session in about 2.5 hours.
Alrighty.
All right,
Thank you.
have a good one, everyone. See ya.
Thank you.
You too. Bye.